Hello and happy Sunday once again, dividend growth stock investors. Colby, the DGI Crab, here with the weekly Sunday video where I'm going to go over each of the 4 tiers and the 60 growth stocks that this channel focuses on to see where the value in the market lies. If you're new to the channel, as I said, I'm only concerned with 60 dividend growth stocks, and I've split those into 4 separate categories or tiers based on the age and the time horizon of the investor, which I believe is the most important metric that a dividend growth stock investor should take into consideration. So here we are, March 16th. We've got a fair amount of uncertainty in the market, a lot of it revolving around the Trump tariffs and the uncertainty of what that's going to look like, how many of them there are going to be, or how long they're going to last. The market does not like chaos. The market does not like uncertainty. So we're seeing a fair amount of fear going on right now. And I think that this is actually pretty good timing for us active investors, especially if you are buying ETFs, because the ETFs that we would focus on, whether it be an S&P 500 fund like VOO, a dividend appreciation fund like VIG or SCHD, these are all funds that have an ex-dividend date coming up in the very near future as we're getting towards the end of the first quarter. And if you're not of a mind to roll the dice on some individual stocks right now, this particular week could be a nice week to just double down on ETFs. Markets are generally down kind of across the board right now as we're going through a bit of a correction. And you could load up a little bit more on those ETFs before they go ex-dividend and get yourself a little bit higher of a dividend payment if you are, again, not of the mind to spend your money right now on single stocks with the uncertainty going on. Now, before I go further, I will say I'm not a professional financial advisor, and the content of the channel should be considered primarily for entertainment. The opinions expressed regarding investments are my own, and you should always perform your own due diligence prior to investing your hard-earned money. And if you are new to the channel, this is my personal DGI Crab allocation strategy. Every week I put 50% of my investment capital into age-appropriate ETFs, so I have automatic diversification. Now, for the single stocks, I'm looking for those that are yielding at least 30% or more above their 4-year average yield. Not 30% yield, 30% higher than their 4-year average yield. I have a personal list of top 10 favorite stocks. If those are yielding about 20% or more above the 4-year average, then I'll go ahead and buy those regardless of what age tier they happen to be in. Now, I'm pretty strict about remaining within my own tier unless there happens to be a stock in a different tier that is yielding 50% or more above the 4-year average yield. There's still multiple stocks in this list of 50 that are in fact doing just that. And if there's not a buyable stock within my tier at any given time, I will add more to ETFs. I'm not going to invest less if I don't see value in the individual stocks. I'll just put the money into ETFs because that's going to increase my dividend income as well. So now we're going to jump over here to the spreadsheet as we do, starting with tier 1. This is the age 30 or 18 to 30-year-old bracket where we are looking for not huge starting yield, usually in that 1 to 1.5% range, but we want double-digit cumulative year-over-year dividend growth. These are sorted by the valuation tab where I'm comparing the 4-year average yield to the current day yield to see how far off that current day yield is to the 4-year average. And if we're in the green, we have hit that 30% or more undervalued. Tier 1 not only has 2 stocks that are in that 30% or more undervalued, but they're also 50% or more above the 4-year average yield. Nike and Nordson, they've been the 2 dogs in this category for quite a long time right now. But let's think about the market correction that we've been seeing, where we've seen this massive tech sell-off. If you had, within the last 6 months, been buying, say something like Microsoft, and you were paying between $425 to $450 a share, and now it's cratered down here to $388, you might be feeling a little bit frustrated or a little bit panicked because you've seen your overall value of your portfolio going down quite a bit. Same thing for something like Broadcom. Even Visa, to an extent, has seen a little bit of a sell off. But if you've been just kind of steadily buying stuff like Nike, which has been hovering around here in the 70s for quite a while now, you've been adding better than 2% starting yield. And with the market correction, Nike's already corrected. So there wasn't a whole lot further for that one to fall. So you've seen your portfolio as a Nike investor anyway, staying pretty stable right now. And you're getting a nice darn near 2.25% starting yield for that. And then Nordson following up with that at 1.5% starting yield, I still think is a great investment for a younger investor. And then UNH, they are right there at the precipice still of being a good, solid, undervalued stock. I think this just about counts, but if you really want to be a stickler with this and wait for that exact 30%, you're going to have to see that share price fall a little bit more down in the 487 range as opposed to the 488. Now we're going to jump over here to tier 2 for the 31 to 41-year-old investors. We're looking for starting yield more in the 2.5 to 3% range. We want an overall dividend growth rate to be in the high single digits, between 7 and 9%, hopefully, on most of them. Two stocks in the buy zone here, looking kind of similar to tier 1, where we've got Target taking a beating still, yielding well above 4% when the 4-year average yield is just 2.45%. Tier 2 investors have an opportunity to add a very high starting yield here while Target works through all of the I just would consider it social turmoil that they're kind of working through right now. Still got to work on getting their sales up a bit. They're certainly being outdone from what I can tell by like Walmart and Costco and some other similar retailers, but Target is a dividend king. More than 50 years consecutive dividend increases year over year. I think they're going to work their way through this mess. Hershey had been showing some signs of recovery. They'd gotten almost all the way up to $190 a share over the last few weeks. They've dipped back down to 170. Both of these are fine buying options regardless of what age tier you're in because they are trading so low. NextEra Energy, similar to United Health, just missed being in that green buy zone, but I think at 73.55, you could do a lot worse than NextEra Energy at 73.55. You're getting a yield on all of these above 3%. And again, like I said, with Target, you're getting 4.28% starting yield. That's a nice place to start right now. You want to try to buy this stuff at the bottom, you guys. You get a lot more dividend income bang for your buck. And I think you've got a lot more of an opportunity for price appreciation. Just got to be able to wait it out with some of these while they are down. Tier 3, age 42 to 53-year-old investors. Boy, we've got some real value here in this group. This is where we're looking for 3.5-ish% starting yield on average, and we want to see about 5 to 7% overall dividend growth rate year over year. Archer Daniels Midland, still way down. You can still get that starting yield well above 4% on Archer Daniels Midland. Another dividend king facing some problems right now. Hormel, the yield has gotten back down below 4%. Still a really nice buying opportunity on Hormel. Genuine Parts Company, they'd been in the buy zone a few weeks back. Their share price recovered. They got up out of the buy zone. I think Genuine Parts Company, auto parts manufacturer, this is certainly one that's going to be impacted by the tariffs as they stand right now, and the market is showing that. Pepsi, one of my top 10 favorite stocks. This one only really needs to be 20% undervalued for me to want to buy it. It's in the actual just normal buy zone here, yielding 3.65%. Probably my favorite buy out of all 5 of these that are in the green. And then T. Rowe Price, man, this is my worst individual single stock investment. I bought this one way too early a few years ago, and I've just been watching the price fall and fall and fall. But at 5.46% starting yield, you're getting paid a lot of income at this point in time to wait to see if T. Rowe Price can recover. They used to do really healthy dividend increases a few years back, and their dividend increases have been like in that 1 to 2% range over the past few years. And that's really just scared a lot of people off from T. Rowe Price. I think it's a great stock, but it's certainly not performing like a great stock. but yielding nearly 5.5%. Again, you can get paid pretty well to wait and see how they recover. All right, and then for tier 4, age 54 and older investors, we're looking for higher starting yield, maybe in that 5 to 6% range. We still want to see year over year dividend growth in the 3 to 4% range. So when you're not at the point you're reinvesting dividends, you're still getting raises to keep up with a normal year of inflation. Still nothing jumping out at me as an obvious buy here. And when I'm at the point where I'm 54 and older, and if I still haven't gotten that dividend income up to the point where I can comfortably retire off of it, and I'm actively adding to stuff like this, I'm really at that point going to wait for a real bargain on the individual single stocks. We've had some different ones that have kind of teased us with getting close to buy range, but right now, I am going to just sit back and wait on all of these. The high yield stuff is really performing quite well. And again, I always just like to do a quick swing by my top 10 favorite stocks tab. All of these are located somewhere between tiers 1, 2, or 3. Pepsi is the main one that is in the buy zone. I personally think it's not a bad idea for an 18 to 30-year-old investor to go ahead and start adding Microsoft right now. It's yielding ever so slightly higher than the 4-year average, but if you wait for Microsoft to go on sale 20%, you might be waiting forever. So I certainly don't think that this is a bad one to go ahead and maybe roll the dice on. It could have further to fall, certainly, but Microsoft is one of the safest things that you can own, and you're probably going to get 10% annual dividend increases year over year. So nothing wrong with that, tier 1 investors. So the strategy on the single stocks for me would kind of be laid out like this. For your tier 1 group, you'd definitely want to make sure to hit Nike and Nordson, get those undervalued stocks within your own category. And I would still be looking at adding Microsoft, like I was saying. I would take advantage of Pepsi because it's a top 10 favorite of mine. And then Target, Hershey, Archer Daniels Midland, all of these yielding 50% or more above the 4-year average. This is not a bad opportunity, even for a younger person, to add some higher yielding stuff. I know it can be tough when you are adding 1.5%, 2% yielding stuff as a young person. Waiting the years it takes for that dividend snowball through those aggressive increases to really take off can cause some impatience, certainly. Hang in there. Don't be impatient, but you've got an opportunity to add 4% starting yield stuff right now with Target and Archer Daniels Midland. So have a good time with that as far as I'm concerned. Now, your tier 2 group, they're going to want to add Target and Hershey from within their own tier, grabbing some Pepsi, of course, and then reaching up to tier 3 to grab ADM and down into tier 1 for Nike and Nordson. Tier 3 can really spread it around. So Pepsi and Archer Daniels Midland would be my primary interests within tier 3. And certainly adding Hormel, GPC, and T. Rowe Price to round out the stuff in your own tier that's undervalued would be the direction I'd go. Target, Hershey, and Nike, all solid ads for tier 3 at this point. Nordson, even at 1.5% yield, may not be quite enough of a high starting yield in that 42 to 53-year-old range, but maybe the closer you are to 42, Nordson is a good idea still. And then for the tier 4 investors, adding T. Rowe Price at 5.5% yield, 54 and older investors, certainly not a bad play there if you wanted to jump down and grab that. And then the ETF allocations, this is where I usually start. This stays the same every week, you guys. So tier 1 investors, I look at S&P 500 as the primary ETF, VBR to get some small cap exposure, VIG to get some dividend appreciation rolling, and then I do VYMI all the way across the board for the international exposure. Tier 2, same 4, different order. Dividend appreciation is the primary objective, with S&P 500 and small cap still being added to, but not quite as much. Tier 3, SCHD, VYM, DHS, these are my favorite dividend-focused ETFs in this particular category. I give it SCHD the highest allocation because it's done the best from a dividend perspective. And then Tier 4, you've got SPYD for stock exposure, and then high yield bonds, preferred shares, MLPs, 3 covered call ETFs. I think this is the best of the bunch here. And I'm doubling down on the ETFs, especially in tier 4, because there's no value still in that category. All right.